there's very high walk-up periods on private investments. It's not the same as the stock market. You can't just buy something and then something comes up in your life and you need to sell it a couple weeks later. It's not the way that private markets are structured. Traditional venture funds walk-up periods are, 7 to 10 years. So your cash is going to be tied up for that period of time. So it's a very, very long-term mindset you have to have around investing.
Yeah, hey, the market hustle, helping you to succeed, teaching like nobody else. Financial empowerment, giving you strategies for generational wealth, so you can start helping yourself. More money for you to be getting. This the moment for you to be winning and be living financially independent.
Market Hustle community, welcome to episode 41. Today we have another special guest joining us, and that is Chase Prather from ARK Invest. Now, if you're not familiar with ARK Invest, they're doing some interesting stuff in the venture capital space, especially around the democratization of access to different markets for retail investors. And Chase specifically works more on the private market side of things. So you can think of getting access to invest in companies like SpaceX or Anthropic, some of these companies that aren't actually public companies that you can invest in. Well, ARK's doing some interesting stuff to make them accessible to retail investors. So I'm really excited about this episode. I think we are all going to learn a lot, especially when it comes to the venture capital space specifically. And generally, I'm really curious about this space to learn more. So I'm, selfishly excited to ask Chase questions and just get to dive into this and learn a lot more. Before we do dive into this podcast, let's go ahead and welcome our co-host. So Bafi is not able to make it today, but we have Fernando kind of subbing in for him. So Fernando is from one of our earlier episodes this year. If you haven't listened to that episode, make sure to go check it out. Episode 36. It was a great one. And then we also have Pierce joining us for this lovely episode as well. So let's jump in with Pierce. Pierce, how's everything going in Southern California?
It's colder than usual. Other than that, though, man, everything's pretty good. Just enjoying life, trying to max out the Roth IRA before, the next quarter. But other than that, life is good.
Love it, man. Well, welcome back. Welcome to this great episode. I'm excited for this one. Fernando, welcome back to the Market Hustle podcast. How's everything going in Florida?
It's going good, man. I think right now it's getting really hot. It's been kind of like a weird weather out here in Florida. I mean, I've been here for a while. Usually we have winter around this time, as everybody else in the country. But we actually have 80, almost 90 degrees out here. So definitely interesting to see that in Florida. But definitely doing well and got some good family time over the weekend. Last week, some vacation time too. So definitely pumped up for this podcast and yeah, awesome.
I love it, man. I love it. Yeah, it's like the polar opposite here in Washington. We've been like the low 30s, just freezing over here. So enjoy that warmer weather while you got it. Cool. Well, let's waste no time. We have Chase here from ARK Invest. I know this podcast is going to move a little quick. We have Fernando, Pierce, and myself. We have quite, the questions lined up just because we're all eager to learn. So Chase, welcome to the Market Hustle podcast. How are things going on your end?
Yeah, things are quite well. I am also in Florida, so that's how I met Fernando. We were at the Robinhood conference together, bumped into each other. I think we were maybe wearing the same watch, and I complimented him on it, complimenting myself at the same time because I'm a bit of a watch nerd. And he mentioned that you guys had a podcast, and he said, I'd love to have you on the podcast. And honestly, I don't do too many of these things. I have Twitter. I write on there somewhat, but I would say a lot of the stuff I do is kind of more behind the scenes and trying to change that this year. So happy to, be on here with you guys. And I will say, it is extremely, it's surprisingly hot. I moved here from Boulder, Colorado about a year and a half ago. And prior to that, I lived in Salt Lake City. So I'm always used to having the coldest winter you could think of. And then today I walked 6 blocks to get lunch. And by the time I got back, I was like, oh, that was a mistake. I have a podcast and I'm dripping in sweat. I don't need to be, I don't need to be dripping in sweat right before I jump on this podcast. But luckily, it's nice and cool in the building. So
nice. Do you miss the snow at all, or are you kind of good with not having to deal with it anymore?
I think I definitely miss the snow. I went home to Utah to visit some family around January, early January, and it was great to be there for about a week. And then after a while, you're like, waking up and being freezing cold and having to go to the gym to work out because it's too cold to go outside. If I want to go on a run or something like that, it's it's nice to have the opportunity to be warm like all year down here in
Oh yeah.
Florida. And the summertime's hot, but I think people over exaggerate. Maybe that's a people trying to keep too many people from migrating to Florida, but I think it's not that bad really. So
No, that's awesome. That's awesome. I used to live in Arizona, so like I know how it is with the winters where it's a little bit warmer than the rest of the country. I moved to Washington a couple of years ago, and I do like the seasons. Like it's nice to have the four seasons and everything compared to how it is in Arizona, which is kind of similar to Florida, where it's like either hot or just a little less hot.
yeah.
But nonetheless, uh, definitely good to be there in the winter. You don't have to deal with freezing or any of the ice and the snow that a lot of the rest of the country has to deal with. So definitely enjoy that. Enjoy the sunshine. Well, cool. Chase, again, thank you so much for coming on. I'm excited for this. Why don't you maybe just share a little bit about maybe your role at ARK or maybe your experience, like how you got started, with your journey in this investing world, and maybe a little bit about like what really fascinates you about the space you
Mhm.
work in.
Yeah, I think like the journey into venture capital, there's I would say two pretty traditional ways people land in a venture capital role. And mine is by no means traditional. It's very, very untraditional. But traditionally people will either, you go to a good school, an undergrad, you work in investment banking for a couple years. You go to your MBA program. During that program, you intern at a VC fund. Hopefully, they bring you on full time after the internship. If not, at least you have some experience, and then you try to join another firm after that. Um, the other way is to be a founder that, leads a successful startup or be someone, very early at a very successful startup, exit that. And then one of your investors, sometimes they'll bring you on as a venture partner, someone who's more of an expert in a particular space to help them with investments. And if you prove yourself that way, then you can be brought on as a traditional partner and things like that. The way I got into venture capital is, I would say, it's almost like a cheesy story in some ways because it just sounds like somewhat fairy tale-ish or like, one of these motivational books. But I was working, so I'm a college dropout actually. So I don't have a bachelor's degree. I was working at a company, it was a startup based out in Utah. I love the startup culture. I ended up leaving there, joined a consulting firm. In that time, I was doing some consulting on the side, really focused around like biz dev, sales, and just growth in general for early stage startups. And I was loving it so much. And the consulting firm I was working for, we only worked with like Fortune 50, Fortune 100 companies. So these massive companies, contracts would take 6 months to sign. Even getting someone on the phone was like a 2 week process every single time because people are so busy. Nothing's top priority for these large companies. But with these early stage startups I was working with, it was like we could see things progressing like within a week period, pretty dramatically. And you could see, like a small deal meant a lot to people. And I felt like my time was so much more valued at these earlier stage companies. So I ended up reaching out to one of my professors in college, and I just said, "Hey, I know that you worked at a venture capital firm in the past. Bit of a long shot, but is there any chance that I could intern for this firm?" And part of the backstory here is I was always very hesitant to reach out, and I just knew, like on paper, I wasn't the guy. But in my heart and in my experience, I already had some experience working with startups, and that's a big part of being a venture capitalist is helping your portfolio companies with whatever they need, essentially. And I heard this Gary Vaynerchuk podcast actually, which I don't listen to him a ton. I do think he has a lot of good principles, but he's very rah. So, and he had mentioned that if you're not doing what you want to do, reach out to someone that's doing what you want to do and offer to work for them for free for like a 6 month period. And so that's exactly what I did. I reached out to him. I asked if I could work for him for free, while I still did my job in consulting. And he brought me on there. And then they also owned another company, which was Tech Buzz, which is a publication in Utah that covers tech companies as they raise capital. And when I was working at TechBuzz, I was getting to meet like all of the best founders across the state of Utah, and interviewing them around their journey, interviewing them about their companies. I didn't realize how much that was similar to, like my first call and my interactions that I have with founders nowadays. Um, and I think that did prepare me in a lot of ways, almost more than like my internship at the other venture firm did.
Wow.
Um, from there, that was done. They didn't bring me on full time. I did an ex I like to think I did an excellent job. They told me I did a great job with everything, but I could have joined TechBus full time. It just wasn't the exact role I wanted. So I decided to join, and I just started searching and doing more research. I reached out to the founder of Sweater Ventures, Jesse, still a good friend of mine today, and he had said, I was like, I'll do the same thing. Like, I don't care. I'll do it twice. Like, I'll work for you guys for free. I would love to, you know, help out in any way I possibly can. Like, I don't have a ton of investing experience, but I have a little, and I have a pretty decent network from working at TechBuzz and interviewing all these top-notch founders. And he said, there's not really anything you can do for me at this stage. So if I think of something, I'll let you know. And left it at that. I was pretty bummed out. And then maybe 30 minutes later, he called me back and said, actually, I have something for you to do. And that was kind of my start into venture capital. So I was working at Sweater before the third co-founder joined. And for background, Sweater Ventures is the first fund to really go out and try to democratize access to venture capital. They spun up the very first interval fund structure, which is similar to things I do here at ARK. And I was their first like employee, even though I didn't sign any official contracts or anything. I was just working for them for free, doing whatever they asked me to do. And I got to the point where I was, working 80-hour weeks, doing, 35 hours at Sweater and then
Wow.
another 45 at my other job. And I just asked him, they'd raised capital to go out and build this product that they were building. And he had asked me, would you be interested in joining full time? They had already hired on a few full-time engineers at that point, and engineers probably aren't as likely to work for free. So they had hired on a few full-time engineers, and they ended up bringing me on to the investment team there, just as an entry-level analyst, helping with a venture fund and working on the Scout network. So I built out a scouting network of about 150 people. I would meet with them weekly. We would do trainings on just high-level venture 101 things, which at some point I would love to publish those and do, maybe like it, the meetings would take about an hour because people always had a lot of questions. But I think if I just ran through them, I could bust out each of those trainings in maybe 15 minutes and simplify them. And then if people liked it, I could do, more expansive thoughts into those individual trainings. But I worked at Sweater for a little over 3 years, was promoted to an associate there. We made about 30 investments at Sweater, and really, had great mentors at Sweater, learned a lot from the other people that were more senior than me on the investment team. And then I ended up leaving Sweater, joining ARK about a year and a half ago. I've been at ARK on the venture team, really to, kind of do some of the same things, but I think at a different scale and a different stage of investment, also a different vertical focus. So, it's always going to be a bit of a learning curve. But I think that the fundamentals kind of stay the same. So, since I joined ARK, I think we've done a really good job of scaling things and creating a really good process for the venture side.
That's incredible, man. Thank you for highlighting your experience. Like it clearly sounds like, I just like the journey. I mean, the fact that you kind of built your own path, you paved your own path, and you in the early stages, you went out of your way to try to learn, like do whatever you needed to do to get close to the people who knew what you wanted to learn and try to offer some sort of value, like whatever it was. And really, that takes a lot of courage because, like you said, like kind of what you highlighted early is it's easy to feel like, you're just not capable or not worthy of even talking to these people, but that didn't stop you. And you kind of got over that hurdle and just continued to be resilient and find a way into that space that you really wanted to work in. And I love that. Like that's awesome. I'm curious, Chase, maybe if you can highlight a little bit about, a lot of our audience likely isn't aware what venture capital is. So maybe if you can just like
Mhm.
give us like a 101 of what this space really is about, and how it kind of helps build, or like how it kind of correlates or feeds into the startup space.
Yeah.
And Chase, before you go, I kind of want to piggyback out of what Josh said, right?
Mhm.
I think that that word he said, resilience, is what you did, right? And to the audience, resilience is very important. You have to kind of keep trying and keep doing, like you said, you were saying that you would work for free, just to get the experience and the time with those individuals you wanted to be like. So I think that for the audience, the word resilience is a very strong word that people should really go for something they want. A lot of people want a lot of things, but they don't go for it. They say they want to be an investor, but they always leave it as in like a project that's coming up next year or the other year. But what stands out with individuals like you is that you went and got it. You went and did it, right? You went and got it done. You took action. And resilience is something big. I think CEO of NVIDIA mentioned it. Resilience is very important when it comes to anybody that wants to achieve something big. So I think that's awesome. Their journey is very I don't know. I was very focused into it. So you can go ahead, but I just wanted to say
Yeah.
that.
Yeah, and just to add on to what you're saying, I think that yeah, resilience is very key, but I think another thing that I've learned over the last, 5 years in venture is to I don't remember the exact company I worked at. It might have been Womply, the startup I worked at prior to even starting this journey at all. But one of the key principles of a company I worked at one point was to check your ego at the door.
Mhm.
And I think it's easy for people to say like, "Oh yeah, I have a low ego," um, but you really have to like tuck away your pride and do eat scraps for a while if you want something really badly. And if you want something enough, like I believe I'm a firm believer that like anyone is capable um outside of physical things. Like obviously I probably won't be an NFL player. I'm not the biggest guy. I potentially could be if I really, really tried, but it's just something that's going to be much, much harder for me to achieve. But anything that's academic or like traditional jobs, I think that you can really go and get it if you want it bad enough. And I'm a firm believer that I think people are naturally good at things, but I also, I think it's the Kobe Bryant quote that, um, you know, hard work beats talent when hard work forgets to work hard, or when talent forgets to work hard, something along those lines. Like, I think that if you work hard enough, you can achieve whatever you want, essentially. Um, but and also, like I said, just don't have an ego. Like you have to be willing to learn from people. It takes, I think, yeah, it takes a lot of courage. It takes a lot of resilience, but in the end of the day, I think it'll be worth it if, you just go for whatever you want. And obviously it was easier for me because I didn't have responsibilities that a lot of people do. Like I didn't have kids. If all else fails, I could move back in with my mom and live with my mom and, I have to sell my car. Like very, very worst case scenario, I lose my job, I lose everything. Like I still have I had a bit of a safety belt, which I do realize is something that not everyone has. Um, to answer your question around venture capital and just what it is, like what is the broader term and definition of it? The best way to think about it is like really there's two markets in the world. There's the public markets, which you can buy like the NASDAQ, publicly traded stocks, ETFs, mutual funds, all those things. Um, and those are accessible by anyone. And then there's private markets, which are a completely different animal, like very, not that the public markets aren't complex. I'm not an expert in public markets, and I learn a lot here at ARK because ARK is primarily, an ETF provider, and they do a lot of public market investing. Um, and so I'm learning things every day from my coworkers. But I think that the nuances of private markets are it's just a lot more to learn. And it's not as easy to learn in school. I think a lot of it is things that you have to kind of learn by experience, which is part of the reason that venture capital is one of these markets that you can learn by doing more so. And people, I think, value experience more than education when it comes to private markets. But yes, venture capital, there's really like different terms for investment stages and things like that. But, the base level to think about it is like venture capital is private market investing. So typically, the way that venture capital funds work is they'll raise a lump sum of cash. And this is a very traditional mindset around venture, which at ARK we don't traditionally follow. Tradition, we're a bit more, I would say, contrarian with most things we do. But a traditional venture fund, you raise a lump sum of capital, say you raise $50 million, and then your team will deploy that cash over the course of, typically you deploy the first amount of it, but within 2 to 4-ish years or so. Um, and then you save a part of the capital for follow-on investments. So as companies continue to grow, raise their valuation, you can purchase more of that company or at least maintain your share in that company through pro rata rights and doing follow-on investments into those companies so that when a company is successful and has an exit, you still have that ownership percentage of that company and you have great returns. Um,
That's awesome.
and it's very like it's hard to kind of put it into a bucket. I would just because there's so many different ways that you can think about it. Like I just published I'll probably be published by the time this comes out. It should come out early next week. But I'm publishing an article that I wrote around like fund thesis and fund structuring and the different there's like 3 core ways that people follow for like fund structures and investment thesis around venture, which will break it down better probably than I do in words. But uh, there's that, and then there's also like different fund sizes. There's different ways to actually structure the terms of the fund on the back end. And then like investment stages is a big thing as well, because some people might listen to this who work in the industry and say, this guy doesn't really know what he's talking about. Because venture capital is really like seed stage to Series B, which is like the stages of startup companies. For some, the nomenclature of things is often so confusing. But with startups, what happens is traditionally you will raise like a pre-seed round, which is the very first institutional capital you get from investors. This can be from it could even be from your friends and family. It could be from a couple of angel investors, so like high net worth individuals that invest in startups. There's not too many funds that invest like at the true pre-seed stage, but there are some venture funds that invest truly like early pre-seed stage, idea stage for companies. And then there's the seed stage, which is really where like traditional early stage funds start to invest. And a lot of funds that are, seeking alpha, for example, like that's where they will go and invest is in that seed stage of a company. And then Series A is, I would say, probably where most venture capitalists hang out is like between seed and Series B. Um, and then each round, as noted, goes with the alphabet. So A, B, C, D, E, F, G, companies that are very, very late stage will raise, are on their Series I or whatever it is. But,
And
um,
quick
some people will
question,
say like,
Chase.
oh,
Just for the audience,
go ahead.
just for some context, real quick. So from a risk standpoint, because like I think most of us are familiar that a lot of these startup companies are extremely risky compared to maybe your more established, more the large cap public companies like Nvidia, Google, who have all these massive resources and have an established business model. So like maybe I'm just curious. So like, of course, like the first round is probably the riskiest, and then every additional round is like maybe a little bit less risky because these companies are starting to show momentum and they're attracting investors. Is that kind of fair to say?
Yeah, I would definitely say that. I mean, you can look at I did a podcast just came out this week with the head of insights at Carta, and he posts a ton of insights, and maybe I can send you guys his Twitter handle or LinkedIn. You can check him out, but he does a lot of posts, and you actually posted the other day recently that the risk of investing like a seed stage startup, it's very, very, very risky. Um, it's like 1 in 10 will actually make it. Um, And then even at the Series B, some of these companies it's still like maybe 50-50 odds if they raise another round. And so that's not to say that sometimes they don't need to raise another round. Sometimes they become
Mhm.
profitable and they can exit or so on and so forth. But I think that's one thing people need to think about with private investments is like it really is a net zero game. Like we think of investments, traditional venture capitalists think of investments in private markets um, as kind of like each investment you make needs to have the potential to return the entire fund within that one investment. So if I'm investing $1 million in a company, I need to believe that that company can return, and I have a $50 million fund. I need to believe that that company can return $50 million back to me by the time it exits, or it's just not worth me making the investment in a traditional venture fund because they work off of a power law and they understand that, majority, no matter how good of an investor you are, still the majority of your businesses will go out of business. They're not going to
Mhm.
be successful exits, and some of them will exit, but it won't be for much. And so I think that that's like really, yeah, you want to think about it in like a more of a traditional power law sense of like the very small percentage of your investments are going to have extremely good returns with early stage investing.
That's
Interesting.
awesome. So my quick question is, most of our listeners are just normal retail investors, people who just throw money into, Nasdaq stocks and whatnot. What are the benefits of, retail investors investing in VC funds?
Yeah, and that's a great question, especially because that's like a really big focus of mine is like the democratization of venture capital and just private markets in general. Um, and it's one thing I'm very passionate about. So I don't know if you guys know much about like accreditation laws or accreditation status, but if I'm preaching to the choir, stop me here. But I
It'd
do
be good
know
to
that,
remind everybody for sure.
yeah. And so traditional what happened is around the 1940s, there was a laws put in place to prevent people from investing into public companies unless they made enough money or they had enough money in assets. So it's $1 million outside of a single family residence, or you have to make at least $200,000 a year for 2 years in a row with like line of sight to make at least $200,000 again for the next year to become an accredited investor. Because the SEC valued that the private markets were too volatile and too risky, and they feared that retail investors were not, I mean, they're not educated enough and they don't do enough due diligence on these private companies to make these investments in private companies. They think it's just too risky. They think people are going to put all their money in, they're going to lose all their money. As we know today, net worth is not tied directly to your education and how intelligent you are
Mhm.
for private investments. And I think that I personally, not a fan of the laws, but I think that they were put in place during a much different time period, and I think that at some point they will be revised somewhat. And the 2012 Jobs Act actually helped change a little bit of that. So that allowed us to have Regulation A plus and Regulation crowdfunding, which allows non-accredited investors to invest into private companies. It's a little bit more work for the companies themselves to raise capital that way. But I think it's definitely worth it for them, because to answer your question, what is the value add? You know, with the value add of venture funds is, there's a bunch of value adds, but like if you look at the high level value adds of a traditional venture fund investing in you versus a retail investor, it's one check can fill your whole round. One venture fund can write whatever you're looking to raise. Um, and they have very, very good connections. They might be experts in what they're doing. They can help hire talent for you. They usually have people that they've worked with in the past that they can bring back into your company and help you scale. And those are just like the very basic. But they also think of, oftentimes like operational partners, so they can come in and help build things with you and things like that. I would argue that retail investors do a lot of the same things. For example, I think I like to use the example of like the Tesla Model 3 owner who also owns Tesla stock, and having real advocates who are supporting your business, in a real way. and having, one group of investors who owns, maybe there's 7 people at the firm, and that's 7 Teslas, versus having 10,000 investors, and that's 10,000 Teslas, and that's much more of a community. I think community aspect is extremely underappreciated in today's time. Like I really believe, especially when you look at companies just across the board, but one space that I have made some investments in is the gaming sector. And you look at companies like in the gaming space, and you look at the ones that are the most resilient during up and downs and like market trends. It's the companies that have the strongest community because market trends don't really affect community. And I will
Fascinating.
also say another thing that I believe is like hiring is a good example as well. If you have one venture fund that could help you hire and they have a big network, and maybe people are always checking out their website to see, if they invest in this startup, then it must be good. And I want to work at good startups. So that's like a big thing as well. But say, but if I have 10,000 people that are invested in my company, individual investors, and I'm looking to hire a software engineer, what are the chances that one of them is the right fit? And they're already an investor, they're already an advocate of the company. And if they aren't, then the chances that they know someone, like the network effects there, are massive.
Wow, that's very insightful, Chase. Thank you for sharing that. Who would you say this space would be suited for? Because clearly there are, especially nowadays, there's so many new retail investors who have just started learning about the stock market maybe over the last year or two. So like what would you say they need to be aware of when it comes to the risk management side of things? Because like I could see, like for me, like I think it is wise. Like I love to see the democratization of allowing access to different markets. Like I don't think things should be regulated like that. However, I can understand maybe at the time, when they see all these retail investors, years ago getting burned, the government, tends to want to over government sometimes, and that's why we see some of these regulations that restrict. But of course, what's happened, and now what's more clear in 2025 is when we have these restrictions in place, we just limit these massive opportunities to invest in some of these incredible private companies to maybe investors who have educated themselves and who are aware of the risks that are involved. So like I guess for the people who are listening, like what would you say they need to be aware of before they enter the private equity space or invest in a fund that gives exposure to the private equity? Like what should their expectations be?
Yeah, yeah. That's a really good question because I think that's one thing that's overlooked oftentimes. Like it's easy. The path that I went down when I learned about accreditation status was, wait a second, I can't do this. Now I'm mad I can't do this. Let me understand why I can't do this though. And I didn't really pause fully to like understand the risk in it, I would say. I was just, at first like didn't care to understand the risk. I more so was like, no, I should be able to do this. That's un-American. Um, but it is quite risky. I think that, investing in private markets, it's one of the most risky, volatile asset classes by far. So, like I said, net zero is totally possible. I think that people, if you're starting out in investing, and this isn't investment advice, but I would just say like, really, you really want to think about. You really want to think about the risk. I wouldn't invest any money that you couldn't afford to lose, first off. There's very high lockup periods on private investments. It's not the same as the stock market. You can't just buy something and then something comes up in your life and you need to sell it a couple weeks later. It's not the way that private markets are structured. Traditional venture funds lockup periods are, 7 to 10 years. So your cash is going to be tied up for that period of time. So it's a very, very long-term mindset you have to have around investing. And I would
Which you could
also,
argue is good. Like a lot of people, a lot of the people I
yeah,
see get burned is because they have like that trading mentality, like the get rich quick. It's like it kind of forces you to be a long-term investor in a way.
a thousand
I
percent.
think a lot of people also like something a lot of people use. It's kind of like this reminds me of a CD account where you leave those funds in the CD account and you have to have it there for a certain amount of years before you can get out. Now, my question is there like when it comes to private investment, is there like penalties for people to get that money out, or is they have to like get their equity out of the investment?
Mhm. Um, well, I guess it depends on the fund structure, like the structure of the actual fund you're investing into, more so. So if we take, I used the example of like a Reg CF before. Um, That's more like angel investing more than it is like venture capital. When you're
Mhm.
using like regulation crowdfunding, you're picking one company to invest in, which is actually much more risky because you don't have the diversity of a total portfolio that, in the portfolio, maybe 50% of them go bust, but maybe 50% of them do, or like, 40% of them do okay, and then 10% of them crush it. And then it will still balance your returns in that case. But if you're investing in, say, I invest in two companies through Reg CF and it's an angel investment, essentially, the chances of both of those companies going completely bust is actually pretty high. And my return being zero is, and losing everything I invest in those companies is actually like relatively high in comparison to other investments. So I think, and then I'll get to your question around lockup periods. So traditional venture funds, your lockup period is, as I said, like you're committed to invest for as long as it takes to return your cash. So it could be 7, it could be 10, it could be 15 years before you see a dollar back from your investment. That's why oftentimes those investments in funds are reserved for like very, very high net worths, like large family offices, like say, the family of Walmart, they want to go and they want to invest into some venture capital funds because they're fine to lock their cash up for a long time. It's not like they're going to need it tomorrow for one reason or another. Um, and they value the risk and reward of the potential returns of uh, a private fund. But there is a fund structure, which is the fund structure that I would say, pretty knowledgeable about, which is one of the fund structures that I've worked with for a while in my career. And it is called an interval fund. I'm not sure if any you guys are familiar with it. If not, don't feel bad because most people aren't. Even the other VCs I talk to typically don't know much about them. But interval funds are essentially like a mutual fund, and you take it and use it for private markets is like a good way to think about it.
Hmm.
So it has lockup periods, but it's quarterly liquidity windows. And the liquidation from the fund is limited to a percentage of the overall net asset value of the total fund. So, say the fund's $100 million, every quarter, well, the first quarter of that window, I could liquidate up to $5 million out of that fund. So that is a good alternative if you are very worried about putting cash away and locking it for that long. Say maybe you want to do it for 4 years, or maybe it's cash that something really bad happens in your life, you lose your job or something like that, and you thought that this was cash that you could live without, and you were ready to lose it before. Um, and then something life-changing happens and you need to get your cash out. Like that is a good opportunity for people that could potentially have circumstances like that. And most of those fund structures, most people aren't taking their money out. I think everyone goes into those funds, or everyone should go into private funds thinking like I'm going to lock this up for 7 to 10 years, and then take their cash out, if they need it for
They
one
actually,
reason.
or if they actually take. So correct me if I'm wrong, but it sounds like when you're going into this space, it's more around the idea of like when you're giving these companies your money, you got to think of it like you're buying a company and you're only going to get some sort of return if they actually execute on the plan that they have in place or the vision that they kind of have in place. Is that kind of a fair way to think of it?
Yeah, 100%. I think, the way I put it is, unless you're going to get returns if a company you invest in exits, and um, people will say exits or IPOs, but IPO is just an exit into public markets.
Hmm.
But if you have this liquidity event that happens, that's when you're going to get your cash back from an investment. So if you invest in, say, I invested in Amazon when they went public, I could have taken my cash out. I also could hold it, and I would have made a crazy return holding it in the public markets as well. So, I'm personally a very, very long-term investor, and in everything I invest in, I like to think of my investments on like as long of a time horizon as I can fathom.
Hmm.
Um, and if it's not a company I could see myself holding for a very long time, it just doesn't make sense for me to make an investment there.
Gotcha. Okay, that makes sense. And to me, like I understand like the appeal because like for me, like watching some of the startups is fascinating, especially a lot of the interesting stuff different companies have going on with the innovation and just how a lot of these smaller companies, like although they're super risky, like occasionally one does break through. And if you have some sort of stake in that company, well, you're going to be getting a massive payoff. And that, of course, I know we're highlighting a lot of the risk because we want to make sure people have a holistic point of view of the private markets. But I also want to make sure we touch on the benefits because clearly there's some massive returns if you kind of find the right company or if you're invested in the right private company. So like maybe Chase, and I know we're kind of running up on time here soon, but maybe you can share some of like the experiences you've had or you've seen in these markets and how they've amplified people's wealth by taking more of these aggressive investing strategies.
Yeah. And definitely not an endorsement for people to not take risk, of course. The prime example that people think of all the time, or like the example that almost gets made fun of in venture capital spaces, is like Jason Calacanis, who invested in Uber at the angel stage, was, I think, potentially the very first check in Uber. That investment made him $100 million. I think that he invested maybe $10,000 or maybe $100,000. So still
Wow.
a decent chunk of change that he put into that company. Not everyone has like 100,000 or $10,000 laying around. I don't remember the exact number, but $100 million return on either of those check sizes is pretty insane. Um, and there's a lot of you look at the Forbes, uh, you look at the Forbes billionaire list, and you can see in that list the amount of people that are venture capitalists that are in that list, and it shows that the ability to have insane returns from just picking one really good company is there, and so I think that's part of the draw to it. There's this sense of like a bit of a gamble, but it's a very strategic gamble. I think that people undervalue like how much luck plays into things and timing. Like timing is like one of the biggest things that you have no control over.
Mhm.
I think that you can make luck in a lot of ways, like you prepare yourself. And Naval Ravikant from AngelList, one of his things that he talks about is how he kind of has the same philosophy as well that like, there's just blind luck where things come directly to like things just come to you like and you do nothing to prepare for it. You didn't do anything to earn this coming to you. It just
It's
comes
at
to
the
you. It's
right
just
place at the right time, in
yeah,
a
it's just
sense.
pure blind luck. And then
Yeah.
there's the idea of, luck that you've essentially prepared yourself to be lucky. Like I would have never gotten a job doing what I do now if I hadn't taken those other jobs in the past. And me getting this job, I considered, I was excited about it. I was like, oh, I feel lucky right in this moment. But I also earned it in the past from doing the things that I've done and working for it. So I think that that's, one thing to think about. But like timing, for example, like if you raised venture capital in 2021, it was the best year of all time for venture in everyone's eyes at that moment. But now you look at it and it's like that was the peak. And now
Yeah.
markets are still trying to recover. And you see a lot of these late stage companies that raised at valuations that were just insane because everyone had so much cash and they were just throwing it at companies and overvaluing companies. And now you see some of these later stage companies value, raising it down rounds or flat rounds for a number of years and still trying to recover from 4 years ago. So, um, timing's
So
everything.
if you're trying to get into venture capital or like, get your feet wet in a way, um, what should you look for in a company you're trying to look into? Like, if I think like a tech company, right? Like, what are you looking for? Is there any hints you can give us as to like what should someone look for if they want to get in
Yeah.
there, and not, invest in the wrong company?
I think that's like there's really two questions baked in there. There's like, if I want to get into the venture capital like ecosystem in general and become friends or like friendly with VCs and really like become a part of this like startup ecosystem and feel, what's getting people so excited.
Mhm.
Because, most innovation happens in private markets. The most innovative things are happening at private companies, sometimes companies that don't even have a name yet and they're still in stealth, and not a lot of people even know about them. And so my advice there would be, and this ties in with the other question as well, which is more so like how do you pick a good company? Um, my advice on that side would be really wherever you live, there's going to be a startup community. It doesn't matter if you're in like the most rural place of in a state ever. Um, I have a friend that lives like in the middle of nowhere, Utah, and but if he drives 2 hours, he will be like in a startup tech community. And I think that it goes back to like how bad do you want it, but going to these events, looking online, and just even looking at like an Eventbrite and looking up startup events in my area or pitch days or demo days, and just attending those, networking with people. I think asking a lot of questions, and when you're genuinely curious, people will try to answer them the best way they can. I think that like most of these communities are so welcoming. That's what I've always found myself is it's very easy to get involved in a community of founders and venture capitalists and investors, and especially when you have a genuine interest. Picking a good company, that's a different story. I think that you know you have to try your best to see everything that's out there, um, which is very much a struggle because it's impossible. There's so many startups. It's insane. Um, and so, when you're making an investment into a company, like a big thing that I look for is if I feel very good about a company, I still want to do like reference checks with their customers if they're at that stage where they have customers. If they aren't, then I'll do reference checks with who their former employers are and things like that. Like I want to make sure that I'm working with good people is a really big thing. I think the founders are everything. Like I think a good founder, um, a really, really solid founder and team of founders can, they can survive most things. Like I said, like timing, market conditions, luck. They will have the grit to really grind it out, especially when they're passionate about what they're doing. So I think, sitting down with a founder, and if you're, talking to someone and it's a person that you can just sit there and learn from them all day about whatever they're talking about, I think that that's a really good sign. I think that's a very good like first check of like this is someone that could potentially be a good investment. And I think at the early stage, you're oftentimes investing in an idea, which might change because companies pivot all the time at the early stage. But really, you're making an investment in that founder, that team at that early stage. So, it's almost like a marriage. You're going to be in this relationship for, 10 years, and you want to make sure these are good people that you work with.
Going back to ARK, so does ARK provide that for people that are interested or customers or people that want to invest? Do they provide that analysis? Kind of like you could think of companies like Yahoo Finance or Bloomberg or
Hmm.
that full analysis of a potential company that somebody wants to invest in or do some venture capital.
Hmm. Well, we don't do like Reg A pluses or anything like that. So we don't set up individual one-off investments where someone can invest directly into a company. We have funds
Mm.
ourselves set up. And the investments we make out of that fund, we will oftentimes publish our investment thesis around that fund. I do edit them so that they're appropriate for everyone to see because obviously I'm not going to share any confidential information that I have from that company with ARK's audience of millions of people. So I, we make it clear to the reason that we invest in a company where our conviction lies. And one of the key factors is you know, the founders. But we invest across all stages of companies. One thing I talked about before is, um, someone who comes from the private market space might say, "Oh, like Chase is explaining venture capital, and he's giving the whole, like he's calling venture capital all the private market investments." And yes and no, but like like it's really people can, a lot of the names for the stage of investment is varies depending on who you are. So like there's some people think venture capital is just from like seed stage to series B of investments. And then anything after that is like growth stage capital. And then before that is like, like angel investments are a different category for sure. But in general, it's all the same thing. Like you're all
Mhm.
investing in private companies. So yeah.
That makes sense.
I wanted
Yeah.
to talk about just real quick the VC market in 2021. Since then, we've had a huge innovation in AI, and I'm curious how ARK kind of views that, both in terms of like startups getting evaluated or like maybe over evaluated. How do you guys view that with all this huge AI technology now?
Yeah. That's a really good question. I
Mhm.
think it's a difficult question, definitely, but AI is a very, very unique animal. I don't know. I don't know if I like ARK has a team dedicated to research on the AI side. They could probably answer this question better than I can, but I'll do my best. Um, when you look at valuations of startups, people oftentimes think when the people are valuing startups the same way that people are valuing startups in public markets, which is like potentially off of like an EBITDA multiple, or like a, revenue multiple, and that's how you get to their market cap. But that's not the way that you value companies in private markets all the time. Um, you have to value companies based off of what the potential upside is. And if you are investing in a company, say at like $100 billion valuation, but you think it could be $1 trillion company and you can 10x your money, and you have super high conviction that that's going to happen, then I don't believe it is fully overvalued. I do believe that there's a correction in valuations across the board in private markets that we've seen happen since 2021. I think that the AI space, some companies are definitely overvalued, and we'll see some companies struggle to raise the amount of cash they need to continue to keep up with these giant LLMs that are really, the flagships at this point. But I think, some of the companies that people, the traditional ones that you would say are overvalued, or you might hear people talk about them being overvalued in the media, the potential upside for these companies is so massive that um, it's still there and aligned with the, risk and reward profile. And, we look at it, OpenAI, for example, like, path to 100 million users since they launched their product, the fastest of all time. So the adoption rates for like AI in general are much, much faster. I think the technology is easier to use just because the simplicity of utilizing AI is so easy that my mom can use it fully for things, whereas she's still a person that struggles to potentially log into her email and change the password, So I
Yeah.
think like the user experience and the seamless integration that a lot of these uh, LLMs have created has made their path to success and growth a lot simpler.
Good answer. Good answer. Well, Chase, I know we're kind of limited on time here, and I can't thank you enough for coming on here, sharing your insights. Like you clearly have a lot of education and information that you can share in this private equity space, and hopefully we can have you on again in the future just to tackle because like there's so many different questions I could sit here and ask you, and I'm sure Fernando and Pierce also have many other questions we could ask you. But for the audience who's listening in, what's the best way to find you on social media if we want to like just see what you're up to and learn from you from some more?
Yeah, you can follow me on X, Prather Arc, or it might be Arc Prather. I'll shoot you guys my X handle after this. That's probably the best way.
Perfect.
If you want to shoot me a message on X, feel free. I'll try to get back to you as soon as I can. I don't have a crazy amount of followers on there, so um, pretty active as well. And I try to share as many insights as I can there as well. I really appreciate you guys having me on as well. It's been a great time, and this is one of the things I'm very passionate about is when I say democratization of private investments, it's not just giving access to retail investors, but also giving them the information so that they can go and make an educated, decision on if they want to be an investor in private markets or not. So I'd love to, be back on when we can both find a time that works for everyone. So.
We'll definitely have to do that, just because, yeah, we went more high level in this episode, and I think we covered more about this space just to get, if people are interested, they're going to be able to have a little bit more information about what else is out there from an investment opportunity, because that's really what this podcast is about, is bringing on different perspectives, different people to share what's actually out there and available. Because on social media, it can seem kind of like an echo chamber where there's only one or two ways to invest. And Chase, I can't thank you enough for coming on just to share more insights into this space. Pearson, Fernando, thanks for coming on as co-host. This was a great episode. Lots of gems were left by Chase. And Market Hustle community, make sure you go follow Chase on X so we can get him some more followers. And that way we can all stay in touch with kind of what he's up to, what information he's sharing, and then bring him back on the podcast. We'll leave his social media handle in the bio or the summary of the podcast. So make sure to go check that out. Other than that, episode 41, it was a quick one, but it was a good one. So re-listen to this if you're interested in the private equity markets, because there's a lot of interesting stuff going on in there. And Chase kind of highlighted a lot of it and given us that higher level perspective. So thanks again. Have a great rest of your night, and we'll talk to you guys next week. Bye-bye.
If you feel just like I do, link up, come and join this crew. Hey, I'ma go invest and I'ma watch my money double, take it to another level. With that market hustle, always play it smart. You ain't dealing with a sucker. Take it to another level. With that market hustle, I'ma hustle, hustle. 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 With that market hustle, go.